back to part 3 of our money series. Now, in our last segment, we examined the transition from a gold-backed to a fiat currency system. We focused particularly on the actions of the Fed Reserve under Alan Greenspan, whose policy of lowering interest rates and unregulated market fueled massive growth in the Wall Street financial sectors. This growth ultimately led to inflated asset prices in the stock market and spurred the housing boom. Today, we are exploring the timeline from 2008 global financial crisis to the current era of high debt levels. We'll examine the causes of the crisis and the risky practices, discussing subsequent government and central bank interventions in the form of bailouts and quantitative easing. The initiation of these measures opened the Pandora's box, and subsequently, this magic tool of money printing was adopted by other central banks worldwide. This has significantly increased debt across the personal, corporate, and governmental spheres, raising important questions about our economic future. So stay tuned as we uncover these crucial developments. Given the state of the global economy, it is crucial to revisit this pivotal point in history to understand the events that led to the most significant financial disaster ever recorded. Its effects on income, wealth inequality, and politics are still with us today and can be traced back to this moment in time. The crisis stemmed from a combination of aggressive credit expansion, lax lending standards, and the proliferation of subprime mortgages, which had inflated a precarious housing bubble. This was further fueled by the Federal Reserve's low interest rate policy, encouraging excessive borrowing and speculative real estate investments.
They stopped checking whether the income was even real. They turned to low and no doc loans, so-called liar's loans. No income, no job, no assets, and they were still willing to lend.
How many properties did you buy in this last 5-year period?
I believe in the last 5-year period, I bought about 6 properties.
And what did you buy them for?
For investments.
As the US economy gained momentum in 2004, the central bank began to raise interest rates, initiating a chain reaction. Many financial institutions had offered adjustable rate loans, and as interest rates rose, subprime borrowers faced sharply higher monthly payments. Defaults increased, leading to a drop in home prices below the value of the mortgage loans, setting off a cascade of closures that further depressed housing prices. It reached a tipping point as one subprime lender after another declared bankruptcy, marking the official start of the subprime mortgage crisis. Financial investors desperately sold off these debts, but the global market for these formerly AAA-rated mortgage-backed securities dried up, rendering them essentially worthless. The crisis spread globally as other banks, including European ones, announced similar problems.
By the end of 2007, at least 100 mortgage companies declared bankruptcy or were sold. And then, the crisis spread to one of Wall Street's biggest and most respected firms.
March of 2008 sees Bear Stearns fall.
Not since the Great Depression has the federal government stepped in to help a failing financial institution in this country the way they did over this past weekend.
Panic selling has brought Bear Stearns, an investment bank, to its knees. JP Morgan Chase buys the firm, but only after the government loans $30 billion to buy up Bear's most toxic assets.
It was a manic Monday in the financial markets. The Dow tumbled more than 500 points after 2 pillars of the street tumbled over the weekend. Lehman Brothers, a 158-year-old firm, filed for bankruptcy. Meanwhile, Merrill Lynch, fearing it could be next, agreed in an act of desperation to a shotgun marriage with Bank of America.
Knowing that something had to be done, the infamous bailout started. On September 16, 2008, the US Federal Reserve stepped in to buy AIG, the largest insurer in the US. It was an $85 billion loan, and this was the origin of the famous too big to fail argument.
We're in an urgent situation, and the consequences will grow worse each day if we do not act.
Banks all over Europe are suffering badly. Governments across the world are intervening. They announce a number of bailout packages that offer the banks some protection. More and more financial institutions are taking up the offer of government protection. The financial crisis began in the troubled US housing market and quickly spread to the rest of the world.
The rest of Europe was still hit hard, the results of which was the European debt crisis, a multi-year economic crisis that took place from 2009 until the end of the 2010s. some member states, namely Portugal, Greece, Spain, and Ireland, were unable to repay or refinance their government debt.
Under Ben Bernanke's leadership, the Federal Reserve confronted a rapidly escalating crisis triggered by the housing market collapse.
We needed to put capital into the banking system.
I asked, are we headed for a Great Depression? And Bernanke said, looks that way.
As the crisis unraveled, involving not just the banks the Fed was created to protect, but the hedge funds, investment banks, and insurance conglomerates the Fed had allowed to hide from its oversight.
We saw what happened when one or two large firms came close to failure. Or imagine if 10 or 12 or 15 firms had failed, which is where we almost were.
A modern economy can't function without credit for more than even a couple of hours, frankly, seconds.
We had to be the pacemaker and make it work again.
American taxpayers woke up this morning to learn their money makes up a bailout package the Federal Reserve slammed together to save AIG.
Over the course of the crisis, the Fed would pump trillions of dollars in emergency loans to banks, corporations, and governments around the world. Bernanke single-handedly stopped the run. But when his bailout failed to jumpstart recovery, the Fed upped the ante. With interest rates already at zero, the Fed's only way to juice the economy was to print more money, a technique called quantitative easing, or QE. Beginning in 2009, the Fed purchased over $1.3 trillion of mortgages and debt from failed lenders Fannie Mae and Freddie Mac. It was a temporary nationalization of the mortgage market.
The Federal Reserve, like any other entity, maintains a balance sheet comprising of assets and liabilities. However, its operations have significant implications for the economy. On the asset side, the Fed holds government securities along with various other bonds, loans, and additional reserves including gold and foreign exchange holdings. These assets are crucial for managing both short-term banking liquidity and for controlling long-term interest rates and money supply to stimulate the economy. Liabilities include all U.S. currency in circulation, which is issued by the Fed, as well as the deposits from banks and financial institutions. The Fed also engages in short-term borrowings. These liabilities support the Fed's role in financial regulation and help manage banking operations. Additionally, they assist in the long-term control of interest rates and liquidity to cool down the economy and manage inflation.
Central banks. Believe it or not, they're really important to our everyday lives. Central banks manage the flow of money in a country's economy, so things don't go haywire. They're typically part of the government, although they should operate independently. The specific roles of central banks vary from country to country, but they usually have a few key responsibilities. Mainly, they're in charge of monetary policy to keep prices stable. One way they do this is through what's called the interest rate.
The Federal Open Market Committee is a group of Fed officials given the sole authority of voting on whether to raise, lower, or maintain interest rates. It is made up of 12 members. The FOMC determines the federal funds rate. This rate is set based on several key economic indicators, including inflation rates, the overall health of the economy, and unemployment levels, and is a foundational tool of monetary policy. The following is an excerpt from the recent Fed Chair Jerome Powell's testimony before the Senate Committee on Monetary Policy.
The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the benefit of the American people.
QE and QT are monetary policy tools that central banks worldwide use to influence the money supply. QE effectively increases the money supply, a process some refer to as printing money, by purchasing assets such as treasury bonds, corporate bonds, mortgage-backed and asset-backed securities, municipal bonds, and even foreign government bonds from banks. This influx of capital boosts the bank's reserves, enabling them to extend more loans to consumers and businesses. Furthermore, central banks often reduce the interest rates on bonds they purchase, lowering the cost and making it cheaper to borrow money, encouraging increased spending and investment. Such strategic actions are designed to stimulate economic growth, enhance economic activity, and help reduce unemployment. QT, also known as unwinding the balance sheet, occurs when the Fed sells securities or let them mature without reinvestment. This is generally used to contract the money supply when the economy is growing too quickly and there are inflation concerns. During the COVID-19 pandemic, central banks globally expanded their emergency lending strategies, employing QE, including purchases of corporate bonds, a first in many regions. They also drastically lowered interest rates to near zero. This initiative was part of a broader effort to stabilize the credit markets and assist corporations amid widespread economic disruptions. Simultaneously, governments rolled out substantial relief packages, offering direct stimulus checks to individuals and financial support to businesses. This ensures that immediate economic relief reach both the public and private sectors to mitigate income losses and support consumer spending, as many industries face significant downturns and some even ground to a complete halt. In October 2017, the Federal Reserve began the first major effort to unwind the expansive monetary measures introduced after the GFC with the aim to curb rising inflation. However, the unexpected pandemic in 2020 reversed these efforts, leading to a surprising V-shaped recovery as the world began to reopen. This reopening triggered supply chain disruptions and a resurgence in demand, which in turn caused a sharp increase in inflation, posing a complex challenge for policymakers who needed to balance ongoing economic support with inflation management. In response to the highest inflation rates seen in decades, the U.S. Federal Reserve resumed QT in May 2022, tightening liquidity and raising interest rates. However, this increase in rates also led to higher interest repayments on the substantial national debt. Additionally, the onset of the Ukraine war in 2022 and the recent escalating conflicts involving Hamas and Israel prompted the U.S. to increase its military aid and spending. These developments significantly increased the need for funding and resulted in greater government borrowing. This could undermine the efforts to reduce the money supply. Consequently, this could further complicate the national balance sheet and fiscal dynamics. So, what are the nuanced dynamics shaping the economic landscape today? A major concern is currency debasement, intensified by expanding monetary policies. This has contributed to a depreciation in currency value, adversely affecting purchasing power and savings.
2008, the world stopped. The whole debt system blew up. We had to have a debt jubilee of resetting all government debts around the world at zero so we could afford to service it. We've kept rates low. We've been then using the balance sheet of all of the central banks just to pay the interest on the debt from the previous cycle. So we are paying the debts by printing money, pure debasement. It adds up to a staggering loss of wealth. It is a tax that you don't see. 15% a year debasement is easier than increasing your tax rate 15%, which is politically unacceptable, which is what they need to do to pay the debt, because the printing of money just debases the currency. So you are paying it. We are all paying it.
Demographic shifts such as the aging population, especially with the retirement of the baby boomer generation, the largest in history, and the resulting decline in labor participation rate are placing stress on economic structures. With fewer people entering the workforce and a rising dependency ratio, this can lead to slower growth and reduced vitality as the economy struggles to maintain its productive capacity with fewer contributing workers. As national debt surpasses GDP, the disparity between asset owners and wage earners has grown. Low interest rates and increased liquidity have boosted asset prices, enriching those invested in real estate, stocks, and precious metals. Their wealth has grown, outpacing both currency debasement and inflation. In contrast, wage earners whose income haven't kept pace are experiencing stagnant purchasing power, creating a clear divide between economic winners and losers. This growing economic disparity has fueled the rise of populism, with movements like Occupy Wall Street and the Tea Party highlighting people's frustration with the current system. Mistrust and discontent with government control and institutional structures have spurred interest in emerging digital opportunities, notably cryptocurrencies like Bitcoin. For the younger generation, they offer a new way to build wealth, independent of the traditional broken and inequitable financial systems, with the appeal of less government oversight and more financial autonomy. These various threats intertwine to form a complex picture of today's global economy, highlighting both the challenges and opportunities as we move forward. I know I've discussed the impacts of the GFC at length, but many believe that 2008 marked the beginning of the decline of the fiat monetary system. Interestingly enough, it was against this backdrop that Bitcoin's white paper was published, heralding Bitcoin and other cryptocurrencies as a working experiment. Now, given the potential issues facing the fiat system, the decentralized, immutable, and transparent characteristics of digital currencies present a promising alternative. Where else can you find an asset class that puts retail investors ahead of major Wall Street banks and financial institutions? It's a space where teenagers had become millionaires, and a Russian migrant student created the first blockchain smart contract and became a billionaire, and where existing billionaires are placing their faith in the future of this technology. It offers a unique opportunity to achieve generational wealth and financial freedom, accessible to anyone, regardless of geographical location, socio-economic background, race, gender, or age.
It's tempting to believe the crisis is over, but we're simply passing through the eye of the storm. To break free of the cycle of booms and busts, the Fed must find a new way forward. More than ever in its 100-year history, the Federal Reserve holds the future of our economic system in its hands. Can the Fed help foster an economy that's built to last? One not based on stock or housing bubbles, but on sensible, productive investments that will enrich not just some of us, but all? Or will it continue to offer the empty promise of money for nothing?